The stock market is currently closed, and the last reported closing price for Nuburu Inc., trading under the ticker BURU, was $0.34 on Thursday, October 24, 2025, reflecting a significant plus 14.66% gain from the previous close, with an enormous trading volume exceeding 10 million shares. This latest surge, which pushed the stock sharply off its recent lows, immediately raises a critical point of analysis. The consensus narrative of a failing blue laser pure play is being aggressively challenged, not by a sudden technological breakthrough, but by a rapid and profound strategic pivot towards the defense and security sectors, executed through a series of announced acquisitions and joint ventures. This is the unexpected development that retail and institutional investors alike need to digest, as the company is fundamentally trying to change its identity. The conventional wisdom surrounding Nuburu, which often dismisses it as a struggling small cap facing intense competition and significant cash burn in the specialized industrial laser market, is suddenly incomplete, overlooking the high-stakes gamble on defense tech that's now driving price action. The daily price action for BURU has become incredibly volatile, a clear sign of a profound struggle between those betting on the company's laser technology failure and a new, aggressive buying cohort focused on the defense segment transformation. This latest high-volume move, evidenced by the more than 10 million shares traded on Thursday, tells us that a large block of shares changed hands, suggesting institutional activity or a coordinated influx of retail enthusiasm. It is difficult to justify a nearly 15% jump in a single day based purely on the legacy blue laser business, especially given the company's long-standing compliance and financial challenges. The key catalyst here is the October announcement of a strategic alliance with Maddox Defense for a controlling interest joint venture focused on next-generation drone technologies, immediately followed by the news of its plan to acquire Orbit, a defense SaaS operational resilience provider. These announcements are essentially recasting the investment thesis from a niche industrial laser firm to a diversified defense tech-affiliated entity. This massive shift has created a significant disconnect in the market. Longtime holders are likely confused or cautiously optimistic, while speculators are piling in on the news of a potential government and military-oriented revenue stream, which is typically viewed as more stable and high-margin than competitive industrial machinery. The volatility is not merely natural market fluctuation, it's the noise of this corporate identity crisis playing out in real time on the chart. This brings us to the core tension. The market's expectation is often focused on the slow, linear growth of their original blue laser products, but the current reality is a frantic, non-linear repositioning into the defense industry, which is perceived to have a faster capital injection path and higher valuation multiples. The most recent spike is a bet on the success of this high-risk pivot. A deeper dive into the financials, however, tempers this excitement. For the last fiscal year, revenue was alarmingly low at just over $150,000, accompanied by a staggering net loss of over $34 million. The company is, frankly, burning through capital at an unsustainable rate relative to its core product sales. This harsh financial reality explains the desperate need for the strategic shift and why the stock had traded near its 52-week lows just a couple of months ago. The defense pivot, supported by recent capital raises, is essentially a lifeline. But a lifeline comes with its own set of trade-offs, primarily massive dilution through public offerings, which is a significant headwind for the stock price despite the positive strategic news. You have to ask yourself, is the excitement over the potential future defense revenue worth the certainty of current dilution and financial distress? Comment below and tell us which matters more to you when analyzing BURU, the announced defense contracts or the current cash burn rate. The short-selling activity around Nuburu is not just a side note, it's a central character in this volatile story. The most recent official short interest figure is substantial, standing at over 20 million shares, representing a short interest percent to float well over 25%. A number this high places BURU firmly in the high pressure cooker category for short seller targets, suggesting a very bearish conviction from a significant portion of the market, primarily centered on the original laser business's weak financials and the inherent risks of a tiny company attempting a major corporate overhaul. The MERS then the days to cover ratio is extremely low, hovering near 0.1 to 1 day, which typically indicates that while the short volume is high, the liquidity is currently high enough that short sellers wouldn't struggle to cover their positions quickly if the price began to run away from them. This low days to cover acts as a sort of dampener on the short squeeze narrative frequently discussed on platforms like Reddit or X. However, the one metric that remains very relevant is the off-exchange short volume ratio, which has been reported well over 50%. This points to a large portion of short selling occurring on dark pools, a fact that often fuels retail investors' calls for market transparency, suggesting that the true scale of the bearish bets might be underrepresented in traditional exchange data. Firms with large short positions are likely betting that the defense pivot is too little, too late, or that the company will fail to execute on its ambitious acquisition strategy before running out of operating capital. They see the recent stock spikes as an overreaction to non-binding agreements and vague revenue projections. For investors, the short-selling dynamics offer actionable insights. First, the high short interest provides the technical fuel for a sharp rally, but the low days to cover suggests that any squeeze will be fleeting unless the daily volume drops drastically. Second, keep a close watch on the short borrow fee rate, which, while variable, is a direct measure of demand from short sellers. A sudden, sustained spike in this fee would be a strong signal that short seller appetite is increasing and the shares are becoming harder and more expensive to borrow, which often precedes a high-velocity short squeeze event. Lastly, retail investors should track the institutional filings as the institutional ownership is relatively low. Any major institutional buyer announcing a significant long position in their 13F filing could flip the script overnight. Do you think the high off-exchange short volume is smart money hedging, or is it manipulation designed to keep this microcap stock grounded? What's your take on the rising short interest? Smart money or manipulation? Now, let's briefly look at the company's foundational technology, which is still the heart of the original business. Nuburu develops and manufactures high-power, high-brightness blue lasers. The key advantage of a blue laser over traditional infrared or fiber lasers is that metals like copper, gold, and aluminum absorb blue light significantly better than other wavelengths. This superior absorption means faster, cleaner, and higher quality welds and additive manufacturing, 3D printing, of these specific materials, which are critical in the electric vehicle EV battery and consumer electronics markets. The product line includes the AO150, primarily for welding thin foils, and the BL series for higher brightness. The business model was straightforward: sell these advanced lasers to industrial manufacturers. The reality, however, is that this is a capital-intensive sector with long sales cycles, and the company has struggled to translate its technological edge into meaningful, sustained revenue growth and profitability. The older reports show persistent losses, which is typical for a deeply technical pre-scale company, but becomes a significant threat in a challenging macroeconomic climate that makes capital raising difficult. The recent unwinding of a partnership with Humble Inc., an unrelated digital marketing and technology firm, highlights the previous, perhaps unfocused attempts to generate revenue, underscoring the severity of the strategic realignment now underway. Looking ahead, the future outlook for Nuburu Inc. hinges almost entirely on the execution of its transformation plan into defense and security. The expectation is that this pivot, through acquisitions like Orbit and the strategic alliance with Maddox Defense, will rapidly generate new, high-margin revenue and dramatically improve the company's balance sheet and compliance standing with the NYSE. The reality is that acquisitions in this microcap space, especially across international borders, Tecne is Italian, for example, are fraught with integration risk, regulatory hurdles, and potential for overvaluation. The stated goals, like an anticipated $100 million in annual revenue by the end of 2028 from the drone JV alone, are highly ambitious projections that require flawless execution in a highly competitive and politically sensitive industry. The potential catalyst is the successful closing and immediate operationalization of one of these defense acquisitions, demonstrating concrete near-term revenue generation that is immediately accretive. Conversely, a major risk is a failed closing, a regulatory setback, or an inability to raise the necessary follow-on capital, which could send the stock back to its 52-week lows. The expectation that the defense sector is a magic bullet needs to be tempered by the reality of the company's limited capital and execution track record. The market is now pricing an optimistic outcome for a dramatic change in business, but prudent investors must remember the inherent execution risk that comes with a sudden, full-scale corporate transformation. The ultimate success will be defined by not the technology they originally sold, but the entirely new business they are urgently trying to create.